Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, today we're going to be looking at the SPY ETF, which is our proxy for the S&P 500. We're going to be looking at the VIX and the PCC. But before we begin, do you want to learn Elliott wave theory? Well, if so, consider joining the Green Star Trading Patreon at either Tier 2 or Tier 3. You will unlock this 11-part series, which is a comprehensive yet easy to follow video format, teaching you everything you need to know about Elliott wave theory. Well, maybe you want to learn how to chart the way I do as well. Well, I have a series called My Chart, which is an ongoing series which I'll be adding to every month over the coming months, which covers exactly how I set up my chart on TradingView, every tool I use, every drawing I use, every object, every indicator, the whole lot. And we'll show you how to set it up the way I set it up. You don't have to do it this way, of course, but if you're interested, there'll be a dedicated playlist to this too. And finally, maybe you just want to learn how to trade the way I do with my technical methodology, using what I call the standard trade setup. There's a playlist here for that too. We also cover things like trading psychology and risk management. If all of this sounds good to you, then you can unlock all of it by clicking on the link in the description box below, heading over to the Green Star Trading Patreon page and joining Tier 2 for £10 a month. By doing so, you will unlock all of the playlists I've just shown you, as well as a whole raft of other educational content. You'll also get access to the public Discord, where there is a myriad of channels covering multiple subjects, which can keep you engaged and in discussion with all the other members of our community, including myself. I also host weekly live streams which can go on for hours at a time, where I'm happy to take suggestions and cover anything anybody wants to look at, as long as they make the suggestion in advance. But if all of that isn't enough for you, then maybe join Tier 3, where you get every single benefit I've just listed, but you'll also get access to my monthly dividend calendar and stock rating system. Finally, if neither of these appeal to you and you just want to support the channel by donating £5 a month and appreciate the work I'm already doing on YouTube, you still bag yourself an exclusive video each week. Thanks for listening, guys. We look forward to having you on board. Now let's get back to the video. Okay, welcome back, guys. Right then, first thing we're going to do is we're going to go through the Elliott wave counts. Right, and then we're going to come and look at some more things in detail. What I want to do today is I want to look at the extreme readings in the VIX and the PCC, point out some interesting trends to you, and then point out the market behavior at these extreme readings. Okay, but first let's update you on the Elliott wave count. So this is now the primary. Okay, the alternate was a single WXY into here and then 1 2 1 2, expecting a higher move. That was the previous primary. Okay, that you saw in the last video, and the alternate was this, which is now the primary. And I said that if we broke the 61.8% retracement, I would downgrade the previous primary to an alternate, and I did during the week. Now since then, the invalidation points I laid out in that video have both been broken and prices headed lower, so it's been deleted. It's no longer a viable count, and this is now what we're left with, the alternate, which became the primary after the original primary broke down. So, different ways of looking at this now. First thing we want to point out, daily time frame, bullish candle yesterday, long wick to the downside, supported by volume. Okay, so that's a low. Doesn't mean it's the bottom. We could go 3 4 5 A, B, C. We could go lower, but it's a low. Alright, now it could last hours, it could last days, but it's got the formation and it's got the signature of a low, essentially. So from here we can surmise one or two things, and I'm not weighting either of these counts until I see some further price action. We've got a W, X and a Y complete, a zigzag, a flat, a zigzag, and it's done enough to take the price lower, and now we'll come out of here. That's one way of looking at it. Alternatively, this is 1, this is 2, this low here that we're getting is going to be the 3, into 4, into 5, into A, into B, into C, and we're going to go much, much lower. I'm not going to make a call as to which is which yet. If we get 5 waves out of here impulsively, then I think this is the low. If we get a corrective pattern, triangle, zigzag, flat here, then I think this is going to go lower. we need to see a bit more price data. Bullish behaviour yesterday though, so it could be the bottom. But if it's not, what kind of targets can we talk about? Well, let's bring up some targets then. So the first thing we've got here is a 1-to-1 between the W and the Y. Now this doesn't have to be a strong relationship. Okay, it's a strong relationship in a single zigzag because it's the most common relationship, but it doesn't even have to happen then. You can have a long A and a short C and a long A. Same with the first zigzag. Right, the first zigzag in your pattern could be tiny, the second zigzag could be huge. The first zigzag could be huge and the second zigzag could be tiny. The purpose of the secondary zigzag is to just get price lower. Right, now it's already done that. It's gotten price lower, but how much lower does it want to get the price? Right, a lot lower or just a little bit lower? Okay, we don't know that yet. So we've got some targets down here. We've got the 1-to-1, like I said, at 403.10. We've got a 50% retracement of the entire move up from the March 2020 lows, giving back half of everything it's gained. And then we've got the golden ratio of 318, spot 23, 61.8% retracement, so giving back 61.8% of everything the market gained from March 2020 lows. And that's how I see things currently. It's clearer at least than the previous week. You know, I don't really have an alternate count now. This is the count, but it will do one of two things. It's either a deeper Y or it's likely done, one or the other. Okay, and I need to see a little bit more follow through or collapse before I make my mind up. Okay, as I pointed out in the recent video, XRP and ADA, you know, we're talking about Elliott wave long-term picture here. We're not talking about entering trades. Long or short, we would be looking for our own preferable setup under those circumstances to manage risk appropriately. We're not guessing. Or if we are guessing, we're managing risk in the process. Alright, so that's how I see things currently. We're still in the WXY. It's either done with this lower low and this bullish candle, or we've got further to go. So the next thing I want to move on to, so I just want to have a look at the RSI, point out that there is some support in the RSI here for a low. We have bullish divergence, a low, and the higher low from oversold back out of oversold of these last two lows here on the daily chart. So there is some bullish divergence and some support coming in under this candle. Right, there's nothing, no such thing present here on the MACD. There is longer term divergence going back to the lows formed in January, from these lows to what could be future lows or even this current low, and the RSI here. Okay, that was a much stronger sell-off back then. So that's a little evidence, at least in the short term, that there is some bullish divergence here. Now if we look at our moving averages, we're through the 250, the 10 and the 20 are through the 250. The 60 has yet to depth cross. Now what do I say about the 60 crossing the 250 on the daytime frame? On most of the time, and I'm not going to say all the time because that would be wrong, but most of the time it signals a low. Now it could be a significant low before heading lower, or it could be a bottom before making new highs. We haven't had the 60 cross the 250 yet, but it could happen within the next few weeks if this more bearish pattern plays out. Alright, because we don't know if this is 5 within an A or 5 more within the C of the Y, and the Y just wants to be a little lower. That's also a possibility. Alright, now on the weekly time frame, we can see how we've broken the 60 with the 10 and the 20 coming down, and the 250 is all the way down here around the 50% retracement. So if we were going to have that big breakdown to here, that 250 could come up to meet us in the meantime and provide long-term support on the weekly chart. Okay, so there is support there for the bearish case as well. Now if we go back a while, let's just come back out to the daytime frame. Doodling on my chart again, sorry. And let's bring up the volume profile for everything we can see on the chart here with our targets as well. And let's just bring that up. Now we can see that given everything we can see on the chart here, which goes back to November 19, the point of control, the highest peak in the volume, is right on that golden ratio at 318. Okay, the rest of the volume has all been up here at this topping pattern. Right. So for the bearish people out there, the more bearish people out there, a long-term thrust down into this big pool of volume down here near the golden ratio, that would make sense for a deep wave too, and I'm totally cool with that. I'm not being biased either way. So some people seem to get the impression, but unless I openly worship at the altar of the mighty bear, well, that means I'm uber bullish. I'm saying that it's perfectly possible for that to happen. Okay, and for it to break down, and we need further price data to suggest that that's going to be the case. Just as we need further price data to suggest that we're going to rally out of here. I'm just trying to look at things in an even hand. So let's save that now. Let's now move on to the next part of the video, where I want to look at some of these previous highs and previous lows. Okay, so what we're going to do now is we're just going to remove the count, because we're not going to need it for this exercise. Get rid of the long-term count as well. And we're just going to have a look at the VIX. And I've got here all the previous spikes in the VIX. Okay, from the most extreme to the less extreme, and we can compare it to the current behavior in the VIX. As you can see, we're currently trading, well, the VIX is currently moving around what is essentially the lowest of the previous larger volume spikes. Okay, we're currently around there. We're a long way off of these big ones here. Right, so the first thing we're going to do, just because it's obvious, is we're just going to take the spike here, which came all the way up to like 85 on the VIX. Okay, and this was the 17th of March 2020. It's the March low. Right, so we move back to the SPY, and we can take our little, vertical here, and there's our green line, and that's the March low. Okay, sorry, these yellow ones are for the PCC, so I should just lock that in place. Now on the daily time frame, this is where we can be things can be a little deceptive. Let's move that, just hide that temporarily. We do not get an extremely bullish candle at the low, right? We get declining volume on a bearish candle, but we do not get a bullish candle at the low with a big long wick or a hammer or anything like that. The body is not an abandoned baby either. Okay, like for example this little island structure up here. So there was nothing on the daily close to convince you really that that was the low. Okay. What we did see, however, on the momentum that was convincing was we saw this rising lows in the RSI. Right. Bearish momentum dying off. Okay. Now in the MACD, however, the low on the MACD is the low on the chart. There was no warning or divergence here at all. So it was not an easy low to call. Alright. It was one of those ones that when it came and it moved off impulsively, you just had to be prepared to take it at the end of the day. And it would have been, under the circumstances, as I remember quite clearly, a state of fear and panic. That the markets are in an extreme state of fear and panic, and some people were calling, well, with the usual bears were calling for 90% sell-offs and things like that, but the Fed came to the rescue. Now let's move on back in time to our next set of lines here. Now this is a PCC reading around the 18th of December, so we'll come back to that later. We have a VIX reading here, which this huge spike in volume, and this is February 2018. Come back, and if we look, this is February here, 2018, this spike. It's bigger than this one, bigger than where we are currently, but it's not humongous. But it was, I remember it clearly like it was yesterday, a really significant sell-off. Now, I remember the run-up from 2015, right? In 2016, those 15, 16, I remember trading through this, and I remember this period of extremely low volatility became so normal. This little March high, I say little, it was huge at the time, this March higher was suddenly interrupted by this, and this was a big sell-off, guys, for the psychology of the market at the time. Not as big as this one, and not as big as the one which came later in March 2020. So as you can see, the theme of volatility price action has just been increasing the whole time. Now let's come in and have a look at the low here on the VIX. Just hide this temporarily. Right, here we got volume declining. Right, bullish candle here, volume declining, and then a big bullish candle here with a long wick to the downside, supported by volume moving higher, lower between these two, but higher over the previous bearish week, which was a lower close, and a higher close here. Here is the close, higher than this close, bullish wick supported by volume. That's much more of a classic volume pattern, much more of a classic candlestick pattern for a low. We got divergence on the RSI as well. We can see here between the low and the higher low. Okay, so these are all the kind of things we want to be looking for as lows form. Okay, and I'm just pointing. I know this might be a little tiresome for those of you who are more familiar with Elliot, with technical analysis in general. So let's have a look at the VIX now, and let's move back in time to 2000. We don't have anything really during that low period of volatility until we get back to 2011, August 2011. Oh no, we had the August 15 one here. Sorry, excuse me. That's the one I pointed out momentarily, which is this low here. Then we had a swing high and another move lower. Right, these two moves came on declining volume between one another as they set lower lows. The move into the bullish candle, and it was another bullish candle with a longer wick to the outside. It's not an extreme one like a massive hammer or something, but it's there, and it's got increased volume from the bearish week, the prior week before. Right, closing green with a wick to the downside. So a bullish candle there. Okay. You have to excuse the cough. I don't know what it is again. It's just showed up again recently. And some bullish divergence to boot as well. So let's now come over to the 2015 one. Between these two lows, these are higher lows. There's no divergence here. This is just a fast sell-off. Okay. And not the most convincing on the daily time frame of a traditional low being in place. Okay. Now let's move back and have a look at these next readings on the VIX, which are these next sell-offs. Okay, 2011 August, May 2010, and a big reading in October 28th of October 2008. Now this, the end of the GFC, the breakdown from the GFC, we can see huge divergence between these two lows here, and then we set another lower low over here on bullish divergence in MACD and in the RSI, clearly to see. The VIX actually spiked here and then started to subdue. Okay, if we just come over and have a look, so the VIX spiked here on 22nd of October 2008 and then started to decline. We see these other two highs in the VIX here as well. Now generally you can see how there's kind of like a bit of a range. So let's take the lower levels of volatility to the higher levels of volatility, and then the extremes, which are represented by the big sell-offs all the way up here. Right, now if the market's in a primary wave 1 down into a primary wave 2, moving, I think, this is just my assessment, I'm not saying this has to happen, back into this range in the VIX feels about right, because we've had primary wave degree between these two cycle corrections, because this was a cycle wave correction by my count, and the March 20 low was a cycle wave correction. Two big cycle moves, lots of intermediate minor waves, subwaves of those cycle waves between, with spikes in the VIX which terminate at the lows, right, which are the lows of the corrective waves, you understand, going forward in time. So this is marrying up technical and normal classical technical analysis with Elliott waves. We get these 1, 2, 1, 2, so on and so forth, 3, 4, 3, 4, 5, excuse me, into a big cycle wave correction here. And each of these line up with these smaller spikes in the VIX and these larger spikes in the VIX as well. So now let's look at the PCC. Extreme fear and panic readings. We had April 6th of 2020. Now this tends to lag what the market is doing. All right. because they're moving averages. They're coming up. They're a lagging indicator. Okay. So we either get the low of the market on the 23rd of March, we get the extreme fear reading from our moving averages, because they are lagging. Remember, these are moving averages, not the actual chart, because the chart looks like this. Okay, and this brings us up to the 6th of April over extreme fear. Right. Previous one was December 18, which was a higher reading than what we got in the COVID sell-off, right? And yet, let's look at that by comparison. It's tiny by comparison. Right, here it is. This is the taper tantrum. This is the last time the central bank had been on the Fed on a rate raising cycle. Now, I'm not gonna get drawn into fundamentals, but everybody's talking about a rate raising cycle now, and there's basically two kinds of people who are talking about it. You've got those who've been through it before and seen it cancelled a quarter of the way through, halfway through, and they want an about face pulled off and 180 turn on the Fed, Powell pivot, so to speak. And then you've got those who are in their first rate raising cycle and they think it's going to play out. I'm not going to say anything else, alright, because I'm not going to get drawn into fundamentals, but the point is, the low here this sell-off is not as impressive as the sell-off we saw in March, but this was the extreme higher reading in the PCC. Right. Then we get that April 18 sell-off, right? And now where was that? That's just, we get a March low here, right? 29th, and this is once again it's lagging, right? Because we've got those moving averages which are lagging. That's the 23rd of March. That's the 18th of December. Two higher readings all the way back here. So let's look at this one back here in 13th of October 2011, 6th to 13th. Right, now we know what that is if we come back and look at the chart again. Sorry to be dragging you back and forth, but here's the October lows here, right, in 2011. Now this is our first major correction, right, after this cycle wave correction here back in 2008. Which is this huge reading on the PCC. Now, so what I'm pointing out again is how you've had these larger moves which line up with your Elliott wave count and your smaller moves which line up. Okay, so now I've said all of that, you might be saying, that's great, Tom, what's the point of all this? Now let's come and have a look at our current reading. Okay, we're very close to extreme fear and panic. Now we could push a little higher, but the extreme fear and panic state is when the market bottoms. The extreme greed and complacency state is when it tops. Whenever people get extremely bullish, that's the top of the market. Whenever people get extremely bearish, that's the bottom of the market. Alright, so always be wary of people screaming for the end of the world, because it's normally a time to buy. One thing I want to point out here that I do find very interesting before we move on. Now let me just gather up these vertical lines for a minute and share something with you. There is a trend here, and a quite clear one. Each subsequent reading on the PCC is bouncing off this descending trend line. Right. Now we could be, it's just an observation, we could be in for another one of these, right? Boom, an absolute fucking shitstorm. Or, if my longer count is correct, this will terminate, this is a lagging indicator, remember, we've pointed out that it comes behind the VIX and the actual low in the market. Right, by the time the moving averages catch up with the actual data. So what if we've already bottomed? This has to just come up to the trend line, and then we come back down and work our way back into a new move higher to create greed and complacency. Now it may take a little longer. We may have further to go, and we may have to come up to or maybe even through this trend line. But I think, having pointed out the lagging nature of this downward trend line, the fact that we've had bullish support on the daily, we may have done enough to have come up to this thing again. Now, like I said, it's also possible that we take a little bit longer. I just wanted to share that observation with you guys, and you can make your own mind up about what you think about it. Okay. And that, my friends, is really all I've got for you today. I don't think there's any need to look at the Nasdaq because it's made new lows as well. It's doing the same thing. I will, if I see something significantly different in the accounts, update you, but at the moment I see nothing to tell me that one's going to do something different from the other. So, and you and I know, with the amount of Nasdaq stocks that are in the S&P 500 and how heavily weighted some of them are, that makes perfect sense. So let's now wait and see. If we get a pop out of here, 5 waves up, 3 waves back, that's a buying opportunity to move higher and away free, which could be biblical in scale. Okay, so that's going to be a buying signal if that comes. Let's wait and see if that lagging indicator of the PCC comes up to this lower trend line and then reverses from extreme fear and panic. Let's see if the VIX, having gotten into this range, right, now that we're in it, sets a high somewhere in this range and we get another move back to normal. Continue to trend higher over time. These are just my observations that I'm waiting to see and the things that I expect may happen. I'm not prescient, so and let's see if this trend line gets respected. I'm perfectly open to the idea that we see corrective price action over this week and we just continue to move lower. But it won't change my longer term count. This will just become a deep 2 and that represents an even better, significantly better buying opportunity. Alright guys, thank you very much for joining me on this technical analysis of the SPY, the VIX and the PCC. If you're new to the channel, you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below, and as always, a huge thank you to my Patreon subscribers. If you're interested in joining the Patreon, follow the link in the description box below, have a read of the different tiers, see what takes your fancy, and sign up now. And if you're not following me on Twitter yet either, there's also a link to my Twitter feed. I only ever use it to post video alerts. I'm not interested in tweeting and chatting away on the thing. It's just to make up for the fact that for some reason YouTube doesn't seem to inform everybody when I load up a video. So, alright guys, take care of yourselves and I'll be back with you soon. All the best, bye bye.